Welcome back, crypto enthusiasts. Are you ready to turn the cryptic world of futures trading into your personal cash machine? Well, fasten your financial seatbelts, because you're about to take a turbocharged tour through the twists and turns of the trading tracks. Imagine this. You're at the financial Olympics, and each decision could either put you on the podium or have you tripping over your shoelaces. Scary? Maybe a little. Exciting? Absolutely. Whether you're a bullish believer or a bearish skeptic, today we're going to unpack the secrets of futures trading that even the pros might keep under their hats. So, dust off your calculators and put on your thinking caps. Preferably those stylish ones with the propellers on top, because we're about to launch into a world where market graphs are roller coasters, and you're the thrill-seeking rider. Get ready to learn and leap into futures like never before. Let's roll up our sleeves and dive in. Welcome to Crypto Dominion. I'm Alison, guiding you through the thrilling realm of cryptocurrency, NFTs, and blockchain. Hit that subscribe button for a journey filled with expert insights and a touch of fun. Don't miss out, we're giving away a sleek MacBook. Like, subscribe, and leave a comment to enter. Be sure to watch till the end for all the giveaway details. Ready to dive into the world of digital currencies? Let's get started. The basics of futures trading. Futures trading might sound like something only suited for the wolves of Wall Street, but believe it or not, it's accessible to anyone with a knack for speculation and a bit of market savvy. So what exactly are futures contracts? In the simplest terms, a futures contract is a legal agreement to buy or sell a particular commodity or financial asset at a predetermined price at a specified time in the future. Whether you're eyeing stocks, gold, oil, or cryptocurrencies like Bitcoin, BTC, and Ether, ETH, futures contracts allow you to lock in prices and hedge against market volatility. The principle here is buying low and selling high, or vice versa, depending on your market forecast. You're essentially speculating on the asset's future price movement. For instance, if you believe BTC will soar in the next 3 months, you might enter into a futures contract to buy it at today's price, betting that you'll profit from the price difference if your prediction holds true. Conversely, if you think the price will drop, you could sell a futures contract and buy it back later at a lower price, pocketing the difference. This concept isn't just for the financial elite. It's used by farmers, manufacturers, and even cryptocurrency enthusiasts to manage risk and plan for future costs or revenues. Advantages of trading futures. One significant advantage of futures trading is the elimination of the need to own the underlying assets. This means you're not buying Bitcoin itself. Instead, you're trading on its price fluctuations. This opens up several benefits. Liquidity. Futures markets are typically very liquid, especially for popular assets like Bitcoin, making it easy to enter and exit positions. Lower costs. Without the need to purchase the asset, you avoid associated costs like storage and security for cryptocurrencies. Market flexibility. You can profit from both rising and falling markets by going long or short on your positions, giving you more flexibility in your trading strategy. How futures trading works. To engage in futures trading, a trader chooses a contract based on the asset they're interested in, such as BTC. Each contract specifies the asset's quantity, price per unit, and a delivery date in the future. Traders then decide whether they believe the asset's price will go up or down by this date, which determines whether they should take a long, buy, or short, sell position. Let's say you believe Bitcoin will rise in the next 3 months. You could enter a long position by buying a BTC futures contract at today's price. If after 3 months Bitcoin's price has increased, you sell the contract at the new, higher price, pocketing the difference as your profit. Conversely, if the price falls, you face a loss when you sell the contract. Futures contracts are traded on exchanges that set rules, including the minimum amount of money, margin, you must put down to hold a position. This is where leverage comes into play. Leverage allows traders to control large amounts of a commodity with a relatively small amount of capital. For example, with a 10-to-1 leverage, you can hold a contract worth 10 times your actual investment. While this can significantly increase potential profits, it also increases potential losses, making it essential to manage risks carefully. These exchanges, like the Chicago Mercantile Exchange for traditional commodities and BitMEX for cryptocurrencies, provide the platforms where these futures contracts are bought and sold. They ensure the market is liquid, secure, and compliant with financial regulations, providing a structured environment for futures trading. By understanding these mechanics, traders can better navigate the complexities of futures markets and position themselves to take advantage of price movements in assets like Bitcoin and Ether. Futures versus other instruments. We've got the basics down, but how does futures trading stack up against other players in the game like options, perpetual contracts, and spot trading? Let's break it down. Firstly, both futures and options are derivatives, meaning they derive their value from an underlying asset. However, while futures commit you to the transaction, options give you the right, but not the obligation, to make the transaction. This fundamental difference means that with futures, you're on the hook whether the market goes your way or not. High risk, high reward, right? On the other hand, futures and perpetual contracts differ mainly in terms of expiration and settlement. Traditional futures contracts have a set expiration date and are settled either physically or via cash at this time, which requires careful planning as the expiration approaches. Perpetual contracts, however, do not have an expiration date, allowing traders to hold a position for as long as they desire. This feature makes perpetual contracts popular among cryptocurrency traders who prefer not to worry about rolling over contracts. Now, compared to spot trading, where you buy or sell a commodity or security on the spot, futures allow you to speculate on future prices without immediately owning the asset. It's like making a bet on tomorrow's price today. Imagine you're in a car dealership. Spot trading would be like buying the car right there and then, whereas futures trading is more like agreeing today to buy the car at today's price, picking it up in 3 months. What's the catch? Well, futures trading allows for significant leverage. This means you can control a large contract with a relatively small amount of capital. But remember, with great power comes great responsibility. Leverage can magnify both gains and losses. So why choose futures? If you're looking for a way to hedge against price movements, manage risk, or speculate on rapid market changes without needing full upfront capital, futures could be your go-to tool. However, remember the risks. It's not for the faint-hearted. Strategic playbook. Now let's get into the playbook of futures trading strategies. Think of each strategy as a tool in your kit, designed to tackle different parts of the market jungle. Go long. This is for the optimists, the bulls of the market. Going long means you're betting that the market will rise. It's like seeing dark clouds and betting it's going to rain. Only here, you're seeing economic indicators and betting the market will go up. Let's say Bitcoin is at $30,000, and you think it'll hit $35,000 in a few months. You go long on a Bitcoin futures contract, and if you're right, you've just bagged a nice profit. Pullback strategy. This is for the patient hunters. Pullback trading is about waiting for prices to dip temporarily before they continue trending upwards. It's like waiting for that iPhone on sale before you snatch it, except you're watching asset prices. You identify a strong uptrend, wait for a price dip, the pullback, and then buy at a lower price before the trend resumes its climb. Trend following. Here, you're riding the wave. This strategy involves identifying a market trend and jumping on board while it's still moving. If the trend is up, you buy. If it's down, you sell. It's akin to surfing. You catch a good wave and ride it to the shore. Breakout strategy. Think of this as the ambush predator tactic. You wait silently for the price to break through a resistance level and then strike. It's high risk, but can lead to high reward if timed correctly. The key here is identifying strong market moves that push prices through key resistance or support levels. Spread trading. This is where you play both sides. You take two related assets and bet on the differential between their movements. For example, betting that Ethereum will outperform Bitcoin. You buy Ethereum futures and sell Bitcoin futures, banking on the spread between their movements. Each of these strategies requires different skills and risk tolerances. It's about matching the right tool to the right situation, and of course, keeping your wits about you. Real-life applications and tips. Applying these strategies in the real world requires more than just knowledge. It requires insight. Here are some practical tips and insights from experienced traders. Risk management. Always set stop-loss orders. This limits potential losses if the market moves against your position. For example, if you're going long on Bitcoin at $30,000, you might set a stop-loss at $28,500 to protect against unforeseen drops. Market analysis. Stay informed about market conditions. Economic indicators, market news, and technical analysis can provide crucial clues about when to enter or exit trades. Tools like MACD, Moving Average Convergence Divergence, and RSI, Relative Strength Index, are invaluable for spotting trends and potential reversals. Practice makes perfect. Before jumping into trading with real money, consider using a simulator to practice these strategies in real-time market conditions. This can help build confidence and proficiency without the financial risk. Leverage carefully. While leverage can increase your profits, it also increases potential losses. Experienced trader and author John Murphy advises to use leverage cautiously, especially for beginners. Expert advice. Connect with trading communities and follow advice from seasoned traders. Many experienced traders share their insights on platforms like TradingView and Crypto Compare, providing real-world applications and success stories. The wrap-up. Futures trading allows traders to leverage their positions, potentially leading to substantial profits. However, with great potential comes significant risk, particularly from market volatility and leverage. Markets evolve, and so should your strategies. Hence, understanding and implementing these strategies requires not only knowledge, but also discipline and a robust risk management framework. Before you go, let's crack open the vault on our giveaway details. We're tossing a brand new MacBook into the ring, so shiny you might need shades. When we hit 50,000 subscribers, it could be all yours. Just hit like, subscribe, and unleash your best comments. The more you comment, the better your chances. Remember to ding that notification bell to catch all the updates. Good luck, and may the odds be ever in your favor. Let's keep the momentum going. Which of the strategies do you feel could best amplify your trading approach, and why? Also, have any market surprises ever thrown your strategies for a loop? And how did you adapt? Share your thoughts and stories in the comments below. If you find your heart racing every time Bitcoin ticks up a point, you're definitely in the right place. Thanks for tuning in and geeking out with us over all things crypto. Be sure to stick around. We've got plenty more crypto wisdom and quips on the way. This is Alison Cypherbyte, signing off. Until next time, keep those digital coins stacking and your smiles cracking.